but it wouldn't surprise me to see gold go to $3,600 an ounce. That would be the base, a full 50% drop. I do look for a global recession, and we're going to see much higher prices. So you're going to get inflation. Some people are going to suffer shortages. At the extreme, you could be looking at mass starvation. If you don't have your gold, get some now. It's a good entry point. If you do, hang on because the fund's just about to begin. We've seen our 50% drawdown off a base of 1,800 relative to 5,300. It's how these things go, and it's going to go up. Now, what were the catalysts for this? Right? But the reason is simple. As I said, they're subject to sanctions. Europe won't buy their energy, so they need the dollars to run basically a war machine for the war in Ukraine. You can see how this is all connected. Oil, dollars, gold, wars, they're all connected. And you really have to look at the global macro and the geopolitical to understand it.
Gold and silver have pulled back from recent highs, but the bigger story may just be getting started. While markets remain focused on interest rates and recession fears, central banks continue accumulating gold, geopolitical tensions remain elevated, and concerns over inflation, energy prices, and government debt are keeping investors on edge. In a recent interview, Jim Rickards argues that this correction is not the end of the bull market. Instead, he believes it's a temporary pause driven by global dollar liquidity, with gold, and potentially silver, positioned to benefit if recession risks and geopolitical tensions continue to grow. Let's break down his outlook.
Gold taking off from here, maybe a little bit lower in the short run, but taking off a lot from here, getting to $10,000 an ounce faster than people expect, and the war getting a lot worse before it reaches a final stage, but the final stage will be pretty dramatic. And we're going to see much higher prices. So you're going to get inflation. Some people are going to suffer shortages. At the extreme, you could be looking at mass starvation. So that's what happens with mere escalation and what we call forever war. Trump's not going to do this. If you can't get a peace deal and a forever war is not sustainable, what's left? Well, what's left is a major escalation of the military operation, some kind of invasion. So look for that. That's going to be a shock that will send gold much higher by itself. So the recession's coming. As far as gold price is concerned, it's very easy to explain. So when we last met, when we met in Amsterdam, gold was in the 4,000s, but by the end of January, it was at an all-time high. It depends on the ticker, but $5,300 per ounce. Some quotes are a little higher. It depends on what ticker you were looking at, but I'll say 5,300. It dropped. Since then, it has dropped all the way to about $4,000 an ounce, up a little bit as we speak. But it seemed to find a floor. It hit $3,900 an ounce, right around there. That's a 25% drop. But if you pick a base, say $1,800 an ounce, which was not too long ago, less than 2 years ago. So if you take $1,800 as a base and then go up to 5,300. Okay, so take that as your gain and then take half of that. That's about where we are in terms of basically 40% decline of giving up 40% of the gains since that baseline of about $1,800. I talked to Jim Rickards about this years ago, and probably the greatest commodities trader of all time. And he said to me, this is when gold had peaked. The earlier peak was about $1,900 an ounce in August 2011. We were talking, it was around 2013. Gold had come down a lot. And Jim said to me, he said, nothing goes to the moon without a 50% drawdown along the way. That's just how commodities trade. And if you don't know that, or you're not prepared for that, you should not be in that commodity. But then we can take a look at fractal mathematics, basically Benoit Mandelbrot, and he introduced a concept called scale invariance. And what it says in volatile systems, if I gave you a 1-week chart and I gave you a 10-year chart, and I just took out the timeline, so you're looking at two charts with whatever scale, whatever timeline, but you don't know which is which. The charts are the same. In other words, that kind of the volatility you see in a 10-year chart repeats on a daily basis. That's what we mean by scale invariance. So taking Jim Rickards' point, which I think is exactly right, and applying it to the current context on a smaller scale, because we're starting not from $250 an ounce, but like $1,800 an ounce. That's what we're seeing. We're seeing one of those drawdowns. Now, based on that, how low could it go? My estimate, this is not a forecast, but it wouldn't surprise me to see gold go to $3,600 an ounce. That would be the base, a full 50% drop from the prior base of 1800, as I described. That's what the math would say. That's what history would say. It won't necessarily get there, but that's a pretty hard floor. But from there, it takes off. So, just if you don't have your gold, get some now. It's a good entry point. If you do, hang on, because the fund's just about to begin. We've seen our 50% drawdown off a base of 1800 relative to 5300. It's how these things go, and it's going to go up. Now, what were the catalysts for this? So I described the math and the volatility and the history of commodities price movements. And I think Jim Rickards got it right, and I know Mandelbrot got it right. So I'm just applying those insights. What were the catalysts for this? Like, why did this happen? Very, very easy. The price of oil doubled. It went up to $60 an ounce to $120 an ounce. I know it came down and it's back up again. But basically, oil is priced in dollars. Everybody needs oil. That means everybody needs dollars. When you double the price, you need twice as many dollars. And where do you get them? There's a global dollar shortage. The banks aren't lending. So one of the things you can do is sell gold and get dollars. And that's what's been going on. So central banks are still net buyers. I think the buying interest is still pretty high, but it is the case that central bankers have had, and sovereign wealth funds and others, traders, have had to sell gold to get dollars to pay for oil because they need the dollars. And Russia has had taken its reserves from 600 metric tons in 2009 to about 2,600 metric tons about 6 months ago. But in the past 6 months, they've been selling. They've sold several hundred metric tons. But the reason is simple. As I said, they're subject to sanctions. Europe won't buy their energy, et cetera. They need the dollars to run basically a war machine for the war in Ukraine. You can see how this is all connected. Oil, dollars, gold, wars. They're all connected, and you really have to look at the global macro and the geopolitical to understand it. But having said that, the fundamentals on gold haven't changed. Net global mining output is flat. Demand is growing. The safe haven aspect of it is still there. There is a temporary blip because some people are selling gold to get dollars to pay for oil. That will change. And then I think we've had our drawdown, so we got that behind us. And I think we'll be off to the races. So I do look for a global recession, gold taking off from here, maybe a little bit lower in the short run, but taking off a lot from here, getting to $10,000 an ounce faster than people expect, and the war getting a lot worse before it reaches a final stage, but the final stage will be pretty dramatic.
So, if I understood correctly, you foresee then this huge move then in gold to still persist by the end of the year. Oil, in the contrary, is also then set to then increase dramatically. Then, if this Hormuz crisis still deepens, with all tankers not being able to go through, so at which oil price would that shock become then a global recession?
Well, I think we're there. Because it's not just about price. I mean, price is a reflection of something else, which is supply. And a very good question. A question I've been asked is, well, Jim, you've been predicting these shortages and price spikes.
According to Jim Rickards, investors shouldn't mistake today's correction for a collapse in a long-term bull market. He argues that commodity markets have historically experienced deep pullbacks before reaching new highs, and gold may be following that same pattern. Rickards believes the recent decline has more to do with a global shortage of U.S. dollars than weakening demand for gold. As oil prices remain elevated, countries need more dollars to purchase energy and finance international trade. To raise that liquidity, some governments and institutions have temporarily sold gold. In his view, that's a funding issue, not a sign that gold's long-term fundamentals have weakened. He points out that central banks continue adding gold to their reserves while global mine production remains relatively flat. At the same time, geopolitical tensions, sanctions, rising government debt, and concerns over the global financial system continue supporting demand for safe haven assets. Rickards believes these structural trends remain intact despite recent price volatility. Another major concern is inflation. He argues that rising energy costs and supply chain disruptions are pushing prices higher across the economy. If consumers begin expecting inflation to remain elevated, it can become self-reinforcing and much harder for central banks to control. Combined with slower economic growth, that creates an environment where hard assets, such as gold, have historically performed well. Rickards also believes the U.S. faces more than a normal recession. He argues the economy has been growing below its long-term potential for years, quietly reducing purchasing power and wealth. If geopolitical conflicts intensify and energy markets remain under pressure, he expects those challenges to become even more severe. His message to investors is clear. Don't let short-term volatility shake your long-term conviction. Rickards believes corrections often create opportunities for patient investors, and if his macro outlook proves correct, both gold and silver could benefit from the next phase of the precious metal cycle. That brings us to the key question every investor should consider.
Inflation, all that, and I stick to that. But why hasn't it happened already? And the answer is that we've been drawing down reserves. But that got us through, and there's been some substitution, as I mentioned, from oil to coal, and there are some net exports from the U.S. and Russia. But subject to all that, we're at the end of that ability to substitute or draw down reserves, and so the impact is going to be felt very quickly. But one thing that gold has not been driven by is inflation. It has been driven by safe haven demand, the desire to get out of U.S. Treasuries to some extent, because the EU has been trying to steal Russian assets. Iranian assets are frozen. Countries, I should say, are more concerned that the U.S. will use its control of the dollar and the U.S., not so much the dollar, but U.S. Treasury securities ledger, controlled by the U.S. Treasury and the Federal Reserve, to freeze assets. And people say, well, what happens if the U.S. wakes up and decides they don't like what I'm doing? So maybe I ought to get some gold to offset that. So and mining output is flat. I'm not saying peak gold, but maybe it is peak gold. I mean, I've invested in a few mining companies. I know just how difficult it is to find high grade deposits. It's getting more and more difficult. So putting all that together, the price of gold has been moving on fundamentals, but we haven't had that much inflation. Well, here it comes. Now the inflation is here, and inflation has three main causes, if you will. One is a supply side breakdown. So supply chains break down. You have scarcity of goods. The shelves are empty. That's by itself is enough to bid up the price. The other one is with higher energy prices. It's not just gas at the pump. That's what Americans and others see. You pull in, you fill up your car, you see the price of gas at the pump. So it's very tangible to most people. It's in your face. But everything moves by fuel. It's, if not gasoline, diesel, and moves by truck. So everything you see in the store, or everything that gets delivered to your house, got there by a truck. And trucks run on diesel. And diesel's prices are going up faster than gasoline prices. But it's not just the shipper has to pay more for gasoline. They raise the price of everything being transported to make up for the fact that the diesel prices are higher. So that feeds inflation through basically all goods and services. But at that point, that tends to be self-correcting, which is prices get high, people, they pay more for gas at the pump, so you cut back somewhere else. You don't go out to dinner. You don't take a vacation. You don't buy new clothes. Whatever it is, you skimp because you can't afford, because you have to pay for the gasoline. It's inelastic demand. But because of that, you tend to get layoffs, higher unemployment, and recession, as we described. But there's a tipping point. There's a tipping point where it moves from the supply side to the demand side, what's called demand pull inflation, where people's expectations go up. Like, hey, this inflation isn't going away. It's getting worse. And I was thinking of buying a refrigerator. I was thinking of buying some new furniture. I better do it now before the price goes up. So you're pulling demand forward, and that kind of psychological behavioral process drives prices. Shutting down inflation coming from the supply side is relatively easy. It tends to shut itself down because unemployment goes up and substitutions and things I mentioned. But shutting down inflation from the demand side is much more difficult because it's behavioral, it's psychological. It's not like a knob and monetary policy that you can just fix. And from that, you'll get much higher interest rates, and that will drive the price of gold a lot higher. So gold has been going up on some fundamental vectors, which we described. It hasn't yet hitched on to the inflation bandwagon because that tipping point over to change the expectations has not happened yet. But we're right on the edge. It's very close to happening. And I expect if you see the war continue and you see higher prices get even higher, and that flows through to a large list of goods and services and expectations change, you're going to start to see that demand pull inflation. And that's going to drive the price of gold a lot higher. And I lived through that in the 70s. I saw it firsthand. That, in the 70s were the same thing. The 73, 74, 73 inflation was a supply side shock. 74 was a really bad recession, stock market crash. But then after that, in 76, 77, 78, that was all demand driven. And then, of course, inflation in the U.S. got to 15%. In 1980, 1981. And that was when Volcker took interest rates to 20%. So we'll see how it plays out. But that's a driver of higher gold prices. It hasn't really kicked in yet, and I expect it will. And then the last thing I'll add, Alexei, I said, later this year, maybe, but it could be 2027. I'm not pushing it off 5 years. Might push it off, 6 months or 1 year. But as we mentioned before, people go, well, Jim, gold has struggled to get back to $5,000 an ounce. How's it ever going to get to 10,000? Well, the answer is that if you think of $1,000 benchmarks, each one is easier than the one before because you're working off a higher base. So when you go from $4,000 to $5,000 an ounce, that's a 25% increase. That's a pretty steep climb. But when you go from $9,000 to $10,000 an ounce, that's only an 11% increase. That's like a month's volatility these days. So you'll struggle. You get to 5 and you get to 6, but when you get that far, it's going to go 8, 9, 10 really quickly. Even though, of course, there's volatility along the way, which is easy to explain because we have a war on that we didn't have then. But yeah, gold is still going to make its way to $10,000. It's going to get there a lot sooner than people expect. The U.S. is in for a severe recession, but let me spend a little time on that, and then I'll pivot to gold. The people focus very much on the word recession, at least in the U.S. It's the rule of thumb is 2 consecutive quarters of declining GDP. That's a recession. Some are longer than others, some are shallow, some are deep, but that's the basic rule. We have not had 2 consecutive quarters of declining GDP. It goes up and down. It's not particularly high at the moment. And so people go, well, there's no recession. What are you talking about? I would say 2 things. Number one, if there's a recession, I expect it will be a technical recession within a depression. And a depression is a different thing. The definition of a depression is growth below trend or below potential, with neither a tendency to collapse nor to return to potential. In other words, if your potential growth is, say, 3.5%, and I think that is reasonable for a developed economy like the U.S. and, for that matter, developed economies in Europe. So if your potential's 3.5%, you're growing between 2 and 2.5%, which we have been on average since 2007. You're in a depression. You don't have negative growth. Your GDP is not going down, but you're nowhere near your potential. And that gap between the potential growth and the actual growth is lost wealth. So I would say the U.S. has been in a long depression since 2007. Japan has been in a long depression since 1990. We've seen these kinds of 20, 30-year depression. In Japan's case, maybe 40 years. They've happened before, in the late 19th century, for example. So, from 2009 to 2019, for example, from the end of the from the end of the great global financial crisis to the beginning of the COVID pandemic, 10-year period, average annual GDP growth in the United States was 2.2%. Well, that kind of proves my point. If your potential is 3.5 and you're growing at you're growing at 2.2, that's a depression. That's trillions of dollars of lost wealth. We're still in that mode. So that hasn't changed. Now, a technical recession, it's easily foreseeable, and this is would be the result of the war in Iran and high energy prices, oil and natural gas, but not just energy prices.
Whether Jim Rickards' forecasts play out exactly as expected or not, his central message is clear. Focus on the long-term trends, not the short-term noise. Geopolitics, inflation, and global debt could continue shaping the outlook for gold and silver in the years ahead. What do you think? Is this correction a buying opportunity, or do you expect precious metals to fall further before the next rally? Let us know in the comments below. If you enjoyed this analysis, subscribe, turn on notifications, and join us for more insights on gold, silver, investing, and global markets. Thanks for watching, and we'll see you in the next video.